Hi, I'm Tom Bradley of Steadyhand Investment Funds. Today we're going to get an update on the Equity Fund, and with me is Gord O'Reilly, the manager of the fund. Gord is one of the founding principals of CGOV Asset Management, located here in Toronto. Gord, welcome.
Thanks, Tom.
Now, Gord, we've had a great run of performance, not just the last few quarters, but really over the last 5 years. Maybe you can take our investors through what's really driven, from your perspective on the fund, what's really driven that performance.
Well, I mean, we have to give a lot of thanks to the strong markets over the last 5 years. They've been exceedingly strong, but part of the unique attributes of the Steadyhand Fund are some of the things that we've helped to the relative performance. Namely, we only have 25 stocks in the Steadyhand Equity Fund. So that creates a competition for capital. If I'm selling Tim Hortons to buy something else, that other thing that coming into the portfolio has to be a really good name. And that also causes us to focus on really high quality names with good dividend paying potential and good strong free cash flows and great management teams. And so some of those unique attributes are really what's led us to outperform in the last little while.
Well, before we get into some detail on some of those names, maybe just a quick overview, sort of the geography of the fund and where you've been adding or subtracting so far this year.
Roughly, we're about 50% in Canada and 25% in the US and then 25% international. There's no hard and fast rule on that, but we found that that's really a nice spot to be just in terms of the fluctuations in the US dollar and the variety of names that we can have in the portfolio. I mean, one of the good examples is earlier this year we bought Loblaws. It was very defensive Canadian name that we never wanted to own in the past, but there was little signs that things were starting to change around at Loblaws, and so far we've been fortunate. It's up about 30% year to date, and it's been good for the portfolio.
Now, we talk a lot about high quality, dividend growth. Maybe you can give me an example, a poster child of something in the portfolio that kind of fits in that category.
Well, most of the portfolio is pretty high quality, but one company that doesn't get a lot of reference in the papers is a company called Pason Systems. It's an energy services company that's really kind of like the iPhone 6 that's getting announced today. Every energy CEO has a Pason display in their home and in their bedroom just to see how well their drilling rigs are doing. And the company's grown its dividend about 19% a year for the last 5 years. The return on invested capital is fantastic. They've got a debt-free balance sheet, and it's beaten the TSE, I think, for the last decade by about 500 basis points a year in terms of performance. So, that debt-free balance sheet, high return on invested capital, lots of free cash, increasing your dividend, that's a great CGOV type of business.
And that's an example of one that's gone international, really. I mean, the world is its oyster. It's got just tons of growth potential.
Well, that's one of the things that attracted us to Pason is, having a company that had a 95% market share in Canada and then going to the United States where it had, not a very significant presence and getting up to 50-60% market share, competing against guys like Schlumberger and National Oilwell Varco. Those are pretty big competitors. The other interesting thing about Pason is the CEO or former CEO still owns about 20% of the company, and Schlumberger could easily buy it out tomorrow if they wanted to, if the Pason wanted to sell, which is, not our core thesis, but it's a nice little thing in the back of your pocket if that ever came to pass.
Let's stay on energy for a minute. The energy stocks have held in the fund and in the market generally have been very good. You had a good run. What do you look for in an energy company, and number one, and what evaluations look like today?
Any company that goes into the Steadyhand equity portfolio, we should be looking for companies that produce high free cash flow, have very sustainable business models, and so it doesn't matter if it's an energy company or a consumer goods company, we're looking for the same things. Some of our energy companies this year have done fantastically well, as you've mentioned, up over 50% for a couple of them. But we still think we've taken some trims on some of them, but we still think the upside in something like a Suncor, which has very long-lived reserves, improving returns on capital, increasing free cash flow per share, and a lot of interesting technologies coming down the pipeline that could improve the environmental footprint and as well just in turn improve the return profile for Suncor, and they're still at 12 times earnings, a pretty good bet.
Gord, let's move on from energy. What are some of the other areas of the market that really interest you?
We tend to really like the industrial sector, and one of the reasons we love that sector is you got a company like CN Rail, which, you know, you're playing the potash industry, you're playing the coal industry, you're playing forestry, you're playing, you know, stuff coming in from China. It's just basically a portfolio of businesses that we can invest in, and our natural offset to that is we're underweight materials because if CN Rail is transporting coal, we don't necessarily have to buy a coal producer. We can just own CN Rail and benefit if there's huge coal production. So we like industrials. We also tend to like consumer businesses that have a huge moat around their brand. For something like a Mead Johnson, which is an infant baby formula maker, they have a huge share in China, and most Chinese parents want the best for their children, just like the rest of us in North America. And so they go buy the Mead Johnson brand, and they've had a fantastic return on invested capital, and growing their business in China and Latin America is just a wonderful consumer brand, sort of double the average of return on invested capital of the rest of our portfolio. So it's been a great business for us.
Gord, most of the things in the portfolio have gone up over this last few years, but you got a couple of headaches in there, things that haven't performed yet, haven't carried their weight. Maybe highlight one for us.
Well, one of the ones we've been a little disappointed in is something called FEMSA, which is they own basically they're the 7-Eleven operator in Mexico, and they also own a huge stake in Heineken, and they also have the rights to Coca-Cola in Latin America. And so it's a great, steady business that, you know, has all the attributes we like, but just there's been a whole bunch of things in the emerging markets in Mexico in particular that have held the shares back. But we still like all the reforms that are being put through in Mexico. We want exposure to that market, and we think that it's going to continue to do well for us in the future. The nice thing is, even though we say it's a bit of a holdback in the portfolio, is it's nice to see that it's still gains in the portfolio. None of the names in the portfolios are at losses. So if that's the worst that we do, over time, that would be very good.
Now, you know, guys, like, we talk quarterly. We have a formal process. We do a quarterly meeting on the phone. I'll ask you about something that's been dead for a year or a year and a half and hasn't done anything. Where do you sort of get your discipline? Where do you guys are very disciplined. You'll hang in if the fundamentals on a company are going well and you believe in it, you'll stick with it for a long time, and eventually it does rise. But what do you search for? What do you look for when you provide that discipline to our clients?
Well, a great example of that would be Birchcliff Energy, which has been in the portfolio for a number of years. It didn't do as well as we liked for quite a while, but every quarter we write up milestones that we're expecting from each of our companies. And Birchcliff was always doing well, even though in a low natural gas price environment, they were still largely profitable and doing everything that they said they were going to do. So we stuck with it. And the Steadyhand shareholders have been handsomely rewarded so far this year. I think it's up 70-odd%, so that's a pretty nice thing. But it's just maintaining that discipline. Sometimes when companies are not meeting our milestones, we have to sell. But as long as the companies are meeting milestones and the managements are doing what they're saying they're going to do, and we can see that progress is being made, we'll hold on.
Well, that's certainly shown through in dealing with you, but also in the performance. So maybe let's finish up. We've had a good run in the markets. We've talked about that. Valuations on lots of stocks have gone up. I know personally I'm a little more cautious and counseling caution with our clients to not get too carried away with these good markets. But how do you come at it? I know you're bottom-up, stock-by-stock kind of investors. What do you see out there?
We tend to look for valuations that are out of whack with their historical norms, and right now valuations are getting up there. You know, the discount to intrinsic value in the Steadyhand fund is not as high as I would like it to be, but there's still opportunities around. We actually did an internal study that showed over the last 5 years the difference between the 52-week high and the 52-week low for all the companies in our portfolio averaged about 40%. And that's not to say that we're the smartest guys in the world and we can pick everything off at the 52-week low. But if you can have that mindset of buying things at a low price and selling them at a high price, that example I just gave you shows there's ample opportunity to create, you know, great returns even in a market where valuations are sort of stretching their historical norms.
Gord, this has been a great update. Thanks for coming down today.
Thanks very much, Tom.